Right now, pause and listen carefully. Something extraordinary is happening in the global silver market, and most people have no idea. While headlines are busy distracting you, silver in China is trading near an $80 equivalent. And that single fact should stop you in your tracks, because markets don't move like this by accident. When premiums explode, it's not noise. It's a signal. And today, that signal is screaming one word: squeeze. When silver begins trading at dramatically different prices in different parts of the world, the issue is no longer volatility, it is credibility. The growing gap between the physical silver market and the paper-based pricing system is one of the most important signals in modern commodity economics, and it often appears long before the broader public understands what is unfolding. On one side, millions of ounces of silver are traded every day through futures contracts, ETFs, and derivatives that may never result in physical delivery. On the other side, manufacturers, refiners, and sovereign buyers are competing for real metal that must be mined, refined, transported, and delivered. When these two worlds stop agreeing on price, the market is quietly telling you that something is wrong. Here's the hook most investors overlook. Paper silver can be created instantly, but physical silver cannot. Futures contracts can multiply supply on a screen, but they cannot produce a single additional ounce. As long as confidence exists, paper prices dominate, but the moment that confidence weakens, when buyers start demanding metal instead of settlement, the illusion of abundance fades, and this is exactly when premiums appear, not as speculation, but as a rationing mechanism. Premiums rise because sellers are protecting inventory, and they may not be able to replace. The divergence becomes especially powerful when it emerges in high-volume, industrial-driven economies like China. These are not emotional buyers chasing momentum. These are price-sensitive, supply-focused participants who require delivery to keep factories running. When such buyers are willing to pay far above the Western benchmark price, they are sending a message the paper market cannot ignore. The official price may say one thing, but the transaction price, the price that actually clears the market, says something very different. This disconnect creates a silent tension. Every paper contract assumes that physical supply will be available if needed, yet rising premiums prove the opposite. The longer this imbalance persists, the more fragile the pricing system becomes. At some point, someone pulls on the thread: an industrial buyer, a sovereign reserve manager, or a large investor demanding delivery, and suddenly the market is forced to reconcile promises with reality. That reconciliation is never smooth. The real question is not whether paper prices can remain detached for a while. They often can. The real question is how long confidence can survive when physical evidence contradicts it. Markets do not collapse from headlines. They collapse from arithmetic, and when physical demand overwhelms synthetic supply, price does not negotiate, it resets. Premiums do not rise randomly, and they certainly do not rise without consequence. In commodity economics, a premium is the market's most honest signal because it reflects what buyers must pay beyond the quoted price to secure immediate physical delivery. When silver premiums begin to surge across major markets, it is not speculation speaking, it is logistics, inventory, and availability asserting control. This is where theory ends and reality takes over. The posted price may suggest abundance, but premiums expose scarcity in real time. Here is the critical hook. If supply were truly sufficient, premiums would collapse, not expand. Sellers only demand higher premiums when replacing inventory becomes uncertain or costly. Mining output cannot be increased on demand. Refining capacity has limits, and transportation adds time and risk. When demand accelerates faster than these constraints can adjust, the system compensates through higher premiums. This mechanism acts as a pressure valve, slowing demand while signaling that the underlying market is tightening. Silver is especially vulnerable to this dynamic because much of its demand is non-discretionary. Industrial buyers cannot simply wait for prices to fall. Production lines require metal regardless of short-term market conditions. When inventory is thin, these buyers are forced to compete aggressively, pushing premiums higher even if the headline price remains suppressed. This creates a misleading calm on the surface while stress builds underneath. The real action is not on the chart, it is in warehouse withdrawals and delivery timelines. Another overlooked factor is that rising premiums often indicate forward supply risk, not just current shortages. Refiners and dealers price in uncertainty when future availability is questionable. Energy costs, geopolitical trade routes, environmental regulations, and financing conditions all influence whether silver can be delivered 6 or 12 months from now. Premiums rise as insurance against that uncertainty. In other words, the market is not just paying for silver, it is paying for confidence. Once premiums become persistent rather than temporary, the structure of the market begins to change. Arbitrage mechanisms weaken because moving metal from one region to another no longer closes the price gap efficiently. Physical silver becomes location-specific, and paper contracts lose their ability to anchor prices globally. This is how squeezes begin, not with panic, but with friction. The most dangerous moment for a paper-driven market is when participants still believe inventories are healthy while premiums quietly disagree. By the time shortages become visible to everyone, the repricing has already started. Premiums are not a warning sign. They are the event itself, unfolding in slow motion. But silver demand is no longer cyclical in the traditional sense, it is structural, embedded deeply into the architecture of the modern economy. This is the hook most analysts underestimate. Unlike precious metals that rely primarily on investment sentiment, silver is consumed, transformed, and permanently removed from above-ground supply. Every solar panel installed, every electric vehicle produced, every data center expanded quietly converts silver from a tradable asset into an industrial necessity. Once used, much of it is never economically recovered. Here is the economic reality that reshapes the entire equation. Global decarbonization and electrification are not optional trends. They are policy-driven mandates. Solar energy alone requires massive silver inputs for photovoltaic cells, and efficiency gains have not eliminated this dependency. Even as manufacturers attempt thrift, total demand continues rising because installation volume grows faster than material reduction. The same pressure exists in electric vehicles, charging infrastructure, advanced batteries, and power grid upgrades. Silver sits at the center of this transition, not as a substitute, but as a requirement. The supply side cannot respond symmetrically. Silver mining is largely a byproduct of lead, zinc, and copper extraction, meaning production decisions are not driven by silver prices alone. This creates an inherent rigidity in supply. Even if demand spikes, miners cannot simply turn on additional silver output without changes in entirely different metals. Markets, that mismatch between elastic demand and inelastic supply, is the breeding ground for sustained shortages. Add defense and technology to the equation, and the picture becomes even more compelling. Silver's unmatched electrical conductivity and antimicrobial properties make it irreplaceable in aerospace, military electronics, medical devices, and high-precision manufacturing. These sectors do not tolerate supply disruptions. When availability becomes uncertain, stockpiling replaces just-in-time delivery, intensifying demand precisely when supply is least capable of responding. The hook here is subtle but powerful. Industrial buyers are not price speculators. They do not sell on rallies. Once silver enters industrial pipelines, it becomes locked demand. This creates a one-way flow that steadily drains available inventories. Financial markets may trade sentiment daily, but factories consume metal relentlessly. As governments push infrastructure expansion, digitalization, and energy security simultaneously, silver demand compounds rather than rotates. Each new policy layer reinforces the last. Markets that treat silver as merely a precious metal miss the deeper truth. It is an industrial lifeline hiding inside a monetary asset. When structural demand collides with constrained supply, price discovery eventually stops being theoretical and starts being unavoidable. The currency debasement rarely announces itself with urgency. It advances quietly through policy decisions that appear temporary, reasonable, and well-intentioned. This is the hook that catches most observers off guard. Governments expand deficits to stabilize growth, central banks suppress interest rates to manage debt, and liquidity floods the system in the name of stability. Yet, over time, the cumulative effect is unmistakable. The purchasing power of currency erodes, not dramatically at first, but persistently. Markets may ignore this erosion for years, but physical assets never do. The critical economic mechanism is confidence. Fiat currency functions because people believe it will retain value tomorrow. When monetary expansion outpaces real economic output, that belief weakens even if inflation metrics appear controlled. Investors, institutions, and sovereign actors begin to seek assets that cannot be diluted by policy decree. Silver occupies a unique position in this transition because it is both a monetary metal and an industrial necessity. It does not rely on trust in a balance sheet. It relies on physics and scarcity. Here is the deeper hook. Debasement does not drive capital into hard assets all at once. It moves first at the margins through rising premiums, increased central bank gold accumulation, and quiet inventory stockpiling. Silver often lags gold in recognition, but accelerates faster once confidence breaks. Because the silver market is smaller and less liquid, it reacts more violently to shifts in capital flows. Even modest reallocations from currency-based instruments can overwhelm available supply. Negative real interest rates intensify this effect when returns on savings fail to compensate for inflation. Holding currency becomes a guaranteed loss. In that environment, the opportunity cost of owning silver disappears. It yields no interest, but neither does debased cash in real terms. The difference is that silver preserves optionality. It holds value across monetary regimes, political cycles, and financial resets. Another overlooked dimension is sovereign behavior. Nations running persistent trade surpluses accumulate to foreign currency. Reserves that lose value over time, diversifying into tangible assets becomes a strategic necessity. Not an investment choice, silver, due to its dual-use nature, offers both financial hedging and industrial utility, making it especially attractive during periods of monetary instability. As debasement continues, markets do not immediately reprice everything. Instead, stress surfaces in specific areas, commodities first, then labor, then capital assets. Silver responds early because it sits at the intersection of money, industry, and scarcity. When currencies weaken, silver does not rise out of optimism. It rises because the unit measuring it is falling. Global commodity markets often pretend the price discovery is centralized, neutral, and uniform, but history shows a different pattern. Leadership rotates, and it almost always shifts toward regions with the strongest physical demand. This is the hook many analysts resist. Asia, and China in particular, does not follow prices. It tests them. When Chinese buyers step in aggressively, they are not chasing momentum, they are responding to real shortages, strategic needs, and long-term planning. That behavior makes Asia an early warning system for global repricing. Unlike Western financial centers that rely heavily on derivatives and leverage, Asian commodity markets are grounded in delivery-based consumption. Manufacturers, refiners, and state-linked entities operate with a simple mandate: secure supply first, negotiate price second. When this group begins paying higher prices, it signals that availability matters more than benchmarks. This is not speculative excess. It is operational necessity, and necessity has a way of overpowering paper logic. Here's the hook that changes perspective. Price discovery is not about where prices are quoted, but where metal actually moves. A futures contract can change hands thousands of times without a single ounce leaving to a vault. In contrast, Asian demand drains inventory directly from the system. Each shipment reduces global availability, tightening conditions everywhere else. This physical flow eventually forces paper markets to adjust, whether they want to or not. China's role is especially influential because of scale and coordination. Its industrial base consumes enormous quantities of silver across energy, electronics, and infrastructure. When that demand accelerates, it does not negotiate quietly, it reshapes supply chains. Premiums rise, delivery times stretch, and arbitrage mechanisms weaken. Western prices may lag, but they cannot remain isolated indefinitely. Global commodities do not respect regional denial. Another overlooked factor is strategic stockpiling. Asian buyers often think in multi-year cycles, not quarterly performance. When supply risk increases, accumulation begins early, before headlines appear. This creates a vacuum effect. Inventories disappear gradually, then suddenly. By the time Western investors notice price pressure, the physical groundwork has already been laid. The real tension emerges when Asian physical prices contradict Western paper benchmarks. That contradiction forces a question markets hate to answer: which price is real? History suggests the answer favors the buyer willing to take delivery. Asia. as leadership in silver price discovery does not come from influence, it comes from consumption. And consumption, unlike speculation, does not reverse easily. When physical demand leads, price eventually follows. Not by opinion, but by exhaustion of supply. Market squeezes are rarely explosive at the start. They are engineered by process, not panic. This is the hook that separates surface observers from serious analysts. In silver, the mechanics of a squeeze begin quietly with small, almost dismissible signals. Slower deliveries, shrinking warehouse stocks, rising lease rates, and persistent premiums. None of these individually trigger alarm, but together they form a pattern that repeats across every historical commodity dislocation. The danger is not in what is visible, but in what is being depleted. The early stage is inventory drawdown. Physical silver moves out of exchanges and into private hands, where it no longer circulates freely. Industrial buyers increase safety stock, refiners delay sales, and investors choose possession over paper exposure. Each action appears rational in isolation, yet collectively they drain liquidity from the physical market. This is where leverage becomes lethal. Paper markets continue to expand claims on metal that no longer exists in accessible form. Here is the critical hook. Squeezes do not require total shortages, only delivery stress, as long as participants accept cash settlement. The system survives. The moment delivery is prioritized, the imbalance is exposed. Even a small percentage of contract holders demanding metal can overwhelm available inventories. This is not a flaw, it is a structural feature of fractional reserve commodity markets. As stress builds, behavior changes, hedgers become cautious, short positions tighten, risk limits, and arbitrageurs withdraw as spreads widen unpredictably. Liquidity thins precisely when it is needed most. Volatility increases, not because of speculation, but because the market loses its ability to absorb demand shocks. Prices begin to gap, not trend. The acceleration phase arrives suddenly, and once participants realize inventory data is no longer theoretical, positioning flips rapidly, short covering becomes urgent, not strategic. Buyers accept higher prices to secure delivery, rather than risk absence. This is where price discovery shifts from negotiation to necessity. Moves that once took months occur in days. The final hook is psychological. Squeezes feed on disbelief. The longer a market suppresses price through structure, rather than supply, the more violent the release when structure fails. Silver's relatively small market size magnifies this effect. It does not require massive capital inflows, only enough demand at the wrong moment. By the time consensus acknowledges a squeeze, the mechanics have already completed their work, leaving price to perform the final adjustment. So remember this moment. Remember when silver quietly screamed its truth through premiums, not headlines. Opportunity rarely arrives with applause. It arrives disguised as doubt. If you train your mind to see signals instead of noise, fear turns into focus and uncertainty becomes advantage. Stay awake. Stay disciplined, because when the squeeze finally arrives, it won't ask if you're ready. It will only reveal who was. Paying attention,